Welcome back to Bunnex Investment Group. If you're new here, please click the subscribe button so that you can become part of our family and never miss any of our valuable content. So in this video, we're going to be talking about a very powerful trading strategy that basically will raise your win rate up to 75 or even 80% of the times. So how do we trade using this particular trading strategy? But before we do so, we have a free Telegram channel where you can join and receive free signals as we trade. Use the link that I've left in the description box below so that you can be part of that community. All right, back to our video. The first thing that you are going to require is patience. Patience to wait for these particular setups. Then 2, you are going to require discipline. Then 3, you are going to require consistency. That is how you calculate your lot sizes, as well as how you the times you enter your trades and the candlestick reversal pattern you use, all that falls into the consistency basket. All right, so basically the only trick here is to box out a day whereby the market is moved. I am on the M15 time frame, and on that M15 time frame, the only thing that I'll be looking for is basically a trend that has been issued. If I see a trend whereby the opening and the closing price is actually in this particular arrangement, opening low at this lowest part and closing at this highest part, the next day I will be expecting to get a day of consolidation. So like in this case, we have this particular day whereby the opening price is almost equal to the closing price. Of course, this is not as equal as possible, but for illustration's sake, I just want to show you the strategy first before we go over to the examples. So after that, the next thing is to anticipate movement of price to the lowest point of that particular day. So the lowest point is this one. So if this is the lowest point, we need to see a grab of liquidity below a day of consolidation. What is liquidity grab? Basically, when market makers are trading, they do not trade like how you and me do. They actually need liquidity. By liquidity, it refers to the money that is left in the markets after you and me have had their stop losses hit, and then after that they can come and take it out. So they know that whenever we are trading, we love to put our stop losses below structure. So if we made our buy at this particular point, we know that several stop losses were going to be at this particular point, which was later hit by this move to the downside. After hitting of stop losses, we call the market has been filled with dump money, and dump money is the money that will be used by market makers to fill their orders. Therefore, these are the points they can die for waiting. They would rather die if this has not happened. They need to see liquidity grab. So at this particular point, that is where you would make your entry, and that entry, you can see the market went to the upside. So what do we mean? Let's now have much more examples, right? Let me remove all these drawings. So we've said the first step is to determine trend of a day. This was actually a move to the upside like that. And on this particular day, we can see that the opening price is equal to the closing price, validating this as a day of consolidation. And if we get a day of consolidation, we box it out and mark its low. So this is the day of consolidation that we have boxed out, and its lowest price is actually this one. So on the following day, we expect to see a retest of that day, or basically a grab of liquidity below, but all that we want is a proper candlestick reversal pattern on that particular price point. We can see that on this day we had this railroad shrek and the market went to the upside. Of course, it came back again and ended again. This is another day of consolidation, as we can see that the opening price and the closing price were also almost equal to each other. We can see that on this day, they retested again the same price, and then they went to the upside for a long period of time. So this was another day of rise, which is confirmed by the prices opening and closing. And after that day of rise, we can see that there was a consolidation day, which is this one. Opening price almost equal to the closing price. We box it out and then we mark the lowest price of that particular day. You can see that there was a trap to that particular day whereby the market makers came to retest and grab some liquidity. Somehow they also use what we call contract induction to go in an opposite direction as a way to build up liquidity. So in that particular case, they actually came, and at candle closure, we were going to make our entry. So in summary of everything that we've said the first thing is to determine trend. Then that trend is what we will use on the following day. If we get a consolidation day on the third day, we'll actually get a candlestick reversal pattern at yesterday's low. So we call it rise, chop, rise. So basically, when we are talking about this particular setup, we say it's a rise, chop, rise, or drop, chop, drop, right? Rise, chop, rise, drop, drop, chop, drop. Basically like that. It's actually something that you can include in your assegai of trading strategies so that you know what to apply on each and every trading scenario. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.